Hey, welcome back to The Dive. Non-fungible tokens, Twitter, the Chinese market, gold, sectors that he likes at the moment, and stories worth noting on the upcoming earnings season are the topics that our guest will deep dive into today. He is the Chief Global Strategist and Research Director at BCA Research. Peter Berezin's joining us today. But before we bring you Peter's interview, do me one quick favor and just go ahead and smash that subscribe button so we can keep making you these videos. Hey Peter, welcome back to The Dive.
Good to be here.
Okay, so let's start off with NFTs. Twitter founder Jack Dorsey's first tweet was converted to a non-fungible token last year and sold for $2.9 million. It was recently listed on the NFT marketplace with the highest bid of less than $14,000. What do you think that this is saying about the NFT market?
Well, that the tweet is probably about $14,000 too expensive still. I think the whole NFT concept is flawed. It's interesting if you look at NFTs, they're marketed as being these unique photos, artwork, whatever you want to call it, and yet in practice, when they're sold in sets where one item is not that different from another item. So why is that? I suspect a key answer is that people are buying NFTs not because they're truly unique works of art. I mean, to be frank, a lot of them are quite ugly. They're buying it because they see these NFTs as sort of as a proxy to the underlying cryptocurrency of the blockchain in which they're listed. Now that's interesting to me because one of the selling points of cryptocurrencies is that they're limited in supply. But if you're going to buy like Bored Ape NFT and regard that as basically just a supercharged version of some Ethereum that you could buy, then there's actually no limit to how much cryptocurrency can be issued. And that, in some sense, defeats the purpose of having cryptocurrency. So I see NFTs as being perhaps at the vanguard of what will end up being a very, very painful period for crypto investors.
Okay, so now Elon Musk has made headlines last week, being a major shareholder of Twitter. According to media sources, Musk is in talks with investors about partnering on a deal. What are your thoughts on Musk's Twitter activity?
So, and let me try to say something that I think hasn't been said, which is that there is a broad class of companies out there whose economic value is actually a lot smaller than their social value. And the New York Times is a good example. The cash flows that the New York Times generates are puny compared to the influence that the New York Times has over the narrative that we engage in. And it's true for the Washington Post and many other media outlets, which is why billionaires like to buy them, because they can get a lot of social influence without having to pay a huge cost. Now, obviously, Twitter is probably $40 billion for Elon Musk. It's not a drop in the bucket. But given the impact that Twitter has over society, it's actually a price that perhaps is worth paying. So I suspect we're going to see other billionaires step in, maybe not try to buy Twitter, but try to buy other media assets that give them kind of leverage over the conversation that we have in society.
Okay, interesting. Okay, so let's move on here. Despite the impact of COVID lockdowns in China, the country's GDP rose by 4.8%, faster than projected. Looking deeper, retail sales are down 3.5%, while residential property sales are down 25%, all while the unemployment rate has risen to 5.8%. Do you have any thoughts on what's really happening in China?
Well, I think there's two issues right now. One, they're going through a major COVID wave, which probably, although it's hard to know for sure, will not end up being just confined to Shanghai. And the numbers are starting to increase in other provinces. And they're in a real difficult situation because this latest strain of COVID, the BA2 strain, is about 40% more contagious than the original COVID strain. And the original COVID strain is about 4 times more contagious than Delta. So the sort of measures that China successfully utilized earlier on in the pandemic may not be enough to contain this new variant. And so what do? Well, there's not a lot of good options. In China, a large fraction of the elderly population has not been vaccinated. Those who have been vaccinated with vaccines that by most estimates are not as effective as the ones used in the West. So I suspect what China will do is continue to play this game of whack-a-mole and try to contain the virus, but it's going to be tough, and there's going to be a lot of lockdowns, and that will weigh both on Chinese growth and obviously also have an impact on the whole global supply chain. So that is a negative for global growth near term. The longer term issue that China faces is around its property market. Property prices are very high. There's been a lot of construction. That property market is going to deflate over time. And the big question is whether China can offset the drag from a weaker property market through other forms of stimulus. They're certainly trying to do so. Whether they'll succeed remains to be seen.
So do you think what's happening in China will affect the US market?
I don't think it will have a lasting effect because China is in the process of manufacturing some of Pfizer's Paxlovid drug, which, as you know, is very effective. You take it within 5 days of symptoms, and the chances of hospitalization are reduced by 90%. So I think at some point later this year, China will be able to open up. And so the impact on the global supply chain that we're seeing now from the lockdowns will be temporary. The property market, that's going to be a different story. If China is not able to offset the weakness in property, that could have some lasting implications, particularly on commodity prices, given that China is such a big source of commodity demand.
Okay, so Peter, this is the first time we've talked this year, so we have to ask, what data are you watching as a result of the ongoing Russia-Ukraine crisis?
Well, I think the key issue, at least for the global economy, is the impact that the horrible war in Ukraine is having on commodity prices. And obviously, the humanitarian cost is in some sense the more important one, but for the global economy, the impact of commodities is also critical. So far, I would say the impact has been fairly modest in some sense and more significant in other sense. Modest in the sense that a lot of the oil that Russia produces is still leaving Russia at a discount to what Russia normally would be selling it for. More severe in the sense that Europe is, of course, taking the brunt of the lack of energy flows. So this is going to have a negative effect on European growth, at least for the next few months, if not longer. The other wild card is around food prices. Food prices have risen quite a bit. Ukraine and Russia together are major exporters of a lot of foodstuffs, wheat in particular. A lot of that wheat goes to the Middle East and North Africa, areas that sometimes suffer from political turmoil. So we have to watch that issue quite closely.
Okay, now given everything that's happening on the macro front, from 8.5% March CPI, a 75 basis point rate hike on the table, and recessionary talks, what sectors do you like right now on the long side?
I think a lot depends on whether the sort of 8.5% inflation reading that we saw this month is the peak. I suspect it is. I suspect actually, at least once the situation in Ukraine stabilizes and the China lockdowns end, we're going to see inflation come down pretty quickly. And indeed, if you look at shipping costs, if you look at used car prices, if you look at lumber prices, they've already been falling. So if inflation does decline, that could allow the Fed to breathe a sigh of relief and take some pressure off the Fed to raise rates by 75 basis points, which Bullard suggested, as you mentioned. So it's possible, not guaranteed, but it's possible that the global economy might have a bit of a Goldilocks period later this year, where the pandemic-related distortions and hopefully the war in Ukraine ends as well. Global growth begins to recover, and meanwhile, inflation is coming down. I'm not sure if it'll last that long, this sort of Goldilocks period, but if it does, it actually could be quite bullish for stocks, especially at a time when equity sentiment is very bearish. And if you look at last reading from the weekly bull bear poll published by the American Association for Individual Investors, the share of bullish investors was at the lowest level in 30 years. So clearly there is scope for upside surprises.
Now, gold has reached a critical level of around $2,000. What are you seeing in the price action of gold?
Well, the most important driver of gold prices are real interest rates. They correlate very, very closely with the price of gold. Real rates have come up, but they haven't come up that much. The 10-year TIPS yield is still slightly negative. I think over time, we're going to see higher real rates in the major economies. That's going to weigh down on gold prices. Now, in the interim, gold, I think, will continue to benefit as a geopolitical safe haven. And certainly, if inflation doesn't come down as quickly as I anticipate over the next 6 to 9 months, that could also help gold. But down the road, I don't think gold is the asset that you really want to hold in large quantity.
Okay, so one more thing before we let you go here, Peter. We have to ask you about the earnings season coming up. What stories have you found most interesting and are following?
Well, I mean, if you look at how companies have been reporting, what you generally see is that they've been beating earnings estimates by a reasonable margin, but haven't been beating revenue estimates by very much. So margins are hanging in there. Now, will that last? It's hard to say. We talk about how labor costs are rising, and they are rising. But the thing is, prices are rising even more. Real wages are declining. I wouldn't be surprised that as we get into next year, we could start to see more meaningful wage pressures. I don't think that's necessarily bad for stocks this year, because this year I think profits will benefit from fewer pandemic-related dislocations, but probably we're going to see a peaking in profit margins at some point next year, and that could very well coincide with the end of this secular equity bull market that began really in 2009.
Okay, great. Well, thank you so much for joining us today and sharing your thoughts with us, Peter. It's been a pleasure.
Thank you very much.
Thanks so much for watching today. We'll be back again tomorrow with the latest news and updates, and you won't want to miss it, so be sure to hit that notification bell before you leave.